we're going to be talking about the truths of trading, harsh realities, and just must knows when it comes to trading. So I would say most trading failures and mindset issues just come from one thing. And this will allow you to overcome FOMO, greed, overtrading, closing your trades too early. And all of this just comes from one underlying problem, which is just trading without rules. The vast majority of traders, 90% of them, do not have any trading rules, no trading rules that they stick to at all times. So they trade without understanding where to exit, where to enter, when to stop trading, even a strategy. There was one trader I was talking to, and he just trades off vibes. He actually joined my program yesterday. He trades off vibes. Well, there's no rules involved with that. If you want to thrive in the market, you need to avoid wasting valuable time making common mistakes. So you must have a set of rules that work well with your trading system. Some people want to scalp, some people want to day trade, some people want to swing trade. Develop your rules to follow your personality. And as traders, we have to be disciplined and rigid with our rules because the market is unstructured. We could show up at the desk every day and start risking cash whenever we want. And sometimes some of us might risk more than we should. And in trading, there's no boss, like I was saying. We are our own boss. There's no one to hold you accountable but yourself. So to successfully thrive in this industry, where you have to be incredibly in control of yourself emotionally, you need to have structure and rules. Humans thrive off of structure and routines and rules. Even if you don't necessarily like it, that's where we thrive from. So beyond just trading rules, it's like having the structure with your time, having a daily structure, monthly, weekly structure. And every trader is unique. And what works for one person might not work for another. Like for me, I'm like a scalper day trader. I like to get in at the right time and I like to get out exactly at the right time. But that might not work for someone else because of their lifestyle, just because of their personality. Maybe they don't even want to spend time looking at charts. So you need a trading strategy that fits your personality. And for example, there's sometimes I would exit a trade because I think it's moving out of my favor. So I'll exit, I'll just secure the win. But there's times it wouldn't move out of my favor and I got a win. But there's other times it slightly moved out of my favor and then it hit my take profit level and it would have never hit my stop loss. And I would say it's like a 50-50 chance for it to do that. This is what I'm talking about here is the 9 EMA exit strategy versus just sticking to stop loss and take profit. Both approaches work. It just depends on your personality. Which one do you want to choose? So not only do you need the strategy that I teach you to suit your personality, your risk tolerance, and your lifestyle, but also you need to learn from me and adapt the strategy to suit your needs. So maybe you could tweak entry and exit points. Maybe you adjust risk management rules. Maybe you focus on different time frames. But once you find a strategy that works for you, stick with it. And consistency is key for the long-term success. And the same thing kind of goes with adapting to fit current market conditions and trends. So in uptrends, I'll focus slightly more on taking calls. In downtrends, I'll focus slightly more on taking puts. It's just being adaptable. And just trading isn't a one size fits all type of thing. We could take the same trade. I could win and you could lose. That's why a lot of people in alert groups don't do that well. They could literally take the same exact trade. Someone wins and someone loses just because what works for someone is not going to work for everyone. So also I kind of want to talk about journaling and reframing your mindset when you journal. So actually in the trading journal template that I give you guys, there's something here. And the question is what did you do wrong? And that's fine. It's a fine question, but sometimes if you focus a little bit too much on what did you do wrong, it's not particularly productive type of framing. The goal of that question is for you to identify what you did wrong, but also what would be useful in your mindset and the way you frame hey, I took a losing trade. What did I do wrong? Instead of focusing oh shoot, I need to be more patient. Why am I not so patient? I'm just an impatient person. That's negative self-talk. Instead, you could say, hey, what are 3 rules I could follow that would prevent me from making those same mistakes? So if your issue is like literally trading at 9:30 a.m., like you trade exactly at 9:30 a.m., you didn't wait for anything, you just took a trade. Well, instead of being like, oh, I'm just impatient, like, oh, I'm impatient. Man, I can't fix my brain. Instead, what are 3 rules you could follow? Hey, maybe at least wait for the first 5-minute candlestick. Maybe have a confirmation checklist. You have to check them off before you enter the trade. Things like that are rules that you could follow that can help you prevent those other mistakes. And how we talk to ourselves, if you think about it, it frames how we respond to our situations. So we can't, first of all, we can't change the way that we talk to ourselves without actually being aware of it. So in your trading journal, not only could you write like, hey, these are the reasons why I entered, these are the reasons why I exited, but also this is how I felt when I entered and exited. And if you keep track of like some of your mindset habits or cognitive habits and you track your thinking throughout the trades, also like if you guys are able to be like on a computer, some people, what has been helpful for some people is literally like, get a Loom subscription and they screen record and mic record their entire trading session. So they can literally see what they were thinking of during the trades, because we might not even recognize either our negative self-talk or even like our overconfident self-talk during the trade. So if you have a way to like track it or journal it to be able to review it, we could also identify the situations that trigger the negative self-talk and just take a hard look at whether we're being constructive or destructive. And, like it's very important to identify that, because that could be a make or break for some people. And yeah, like the journal could just like help you build the self-awareness, and it's just important to be self-aware. So you could start, like, for example, let's say every time there's news, you just really wanted to gamble it, and because you thought you knew, like, for example, let's say like presidential election, Trump's gonna win, so you're taking calls or something like that. And that is like, that could be a negative habit because it was not necessarily based on anything, just your own bias. Maybe that's not a good example because it doesn't happen that often. But also, like, for example, we open up green on the day, but we're heading into a supply zone. But you see prices above the indicators, there was bullish price action, and you just want to go long. You don't want to wait for price to test the supply zone. You go long. And what triggered that was you saw a big green volume candlestick and you're like, there's buyers here. Forget about the supply zone. I'm going to go long. And that could actually be something that happens on a daily basis that would trigger you to make the wrong decision. So it's just about becoming aware. I'm trying to come up with examples for that. And from there, I also want to talk about like some misconceptions of actually being a profitable trader. And one of the major misconceptions is that like, once you become profitable, the journey is complete. But actually, reaching profitability is literally the beginning, because as a trader, it is an ongoing challenge to maintain and sustain profitability over a long time. So you might have heard of people who got lucky. They made $30,000 their first month trading, but they did it with a lot of bad habits. And due to those bad habits, they're not going to be able to sustain their profitability. So this is why we hear of people who make a lot of money with trading and then blow it all up. Well, it's because of their habits. So as traders, it is an ongoing challenge to actually sustain profitability. And sustainability in trading just doesn't come from like, one-off wins. It comes from a repeatable, reliable process. So find a strategy that works for you. Once you identified it, stick to it rigorously. Regularly review your trades to understand what's working and what isn't. And this could also help you adapt to changing market conditions. Because if I had the same type of strategy in the downtrend that I do in an uptrend, that could cause me to lose because I'm not willing to adapt and I'm not deepening on what's working and what isn't working. I had one student, and this was like when the uptrend started and it started really strong. He was taking puts, and like he had a 0% win rate on puts. And he was taking around 50-50 like calls and puts, but then on calls he had a 60-70% win rate. So hey, stop taking puts, just take those calls in an uptrend. So it could be as simple as that. But if you're not analyzing, if you're not reviewing, you could completely miss it. And he did miss it. I had to point that out to him. So that's why it's also very important to keep a trading journal. You could think, oh, I'm doing the same thing every day, but in reality there could be slight little nuanced difference that you might not notice as it's happening day to day, but you only realize it when you're analyzing your previous trades. So I think like a lot of new traders, especially when they haven't experienced changing market conditions, they don't really quickly embrace, really what it takes to be adaptable. And, like even when you have a clear, defined, consistent edge in the market, your profitability could be variable. And like when traders look at their P&L, for example, sometimes they would overanalyze or overinterpret the random ups and downs in the P&L curve. So like maybe they'll take winning trades. They'll be on a win streak. Oh, I'm gonna roll. I figured out the market. I'm gonna win forever. And when they have that type of euphoria, they convince themselves that they're seeing the markets well, and then they might increase their risk taking. On the other hand, this is how we react. So I'm talking about how we react to our P&L. If you're euphoric, someone might increase their risk taking. Or if you feel really confident about a trade, you size up. And on the other hand, when facing losing trades, they might be concerned, maybe having a lose streak, and then they reduce their risk taking. So in confidence, they increase their risk taking. In fear, they reduce their risk taking. These adjustments will cost you money. And really what you should do is come to the market and have your risk taking be constant and moderate, and understand the randomness of the market. When randomness overwhelms an edge over numerous trades, it could be evidence, first of all, that like market conditions have changed. So for example, like uptrends. Oh, every single supply zone's getting broken. Okay, well, that could give us a sign, hey, market conditions are changing. Maybe you should adapt yourself to that. But also, like, it could be normal market conditions. And there could be a point where, let's say you took like 1 or 2 trades a week and all of them are losing trades. And if your trade frequency is low, even over like a year of taking losing trades in a row, this could actually be because you didn't take enough trades, and it could be nothing more than random bad luck. So I'm going to say that again. If you only took like 1 or 2 trades a week and you had a defined consistent edge that's proven over time, but you're only taking like 1 or 2 trades a week, and maybe like it's for a scalping strategy or a day trading strategy. If you're swing trading, 1 or 2 trades a week is fine. But we're just talking about like you reduce the number of trades, so your trade frequency is low, and you lose all those trades. It could literally be nothing more than random bad luck. So in trading, randomness is inevitable. Randomness is a big part of the market. The market is random. All we have is an edge based on probabilities. So instead of like not taking trades because you're losing, you should continue to take trades, because I don't know if you guys ever seen it before. You take 1 trade, that's the losing trade. The next day you don't take any trades. That was the winning trade. The next day you come and take losing trade. The next day you don't trade, or maybe you don't trade for like 3-4 days. And then that's when you would have had a 4-day winning streak. So if your trade frequency is low, you could just have a small sample size and bad luck, a randomness, bad luck. So if your strategy is back tested objectively through historical data, and you see that you have a probabilistic edge, from there, it's up to you to execute no matter how you feel, because this issue is based on feelings and emotion. Being nervous, hesitant, when you know that you have an edge. So like these types of adjustments will ultimately cost you money. And from there, like if we're just talking about day trading isn't about like making a quick decision and executing precisely and winning every single day. It's all about just establishing and following your consistent process. So adhere to the same process day after day and repeat it meticulously, especially if you back tested it and it's proven. So that's important, because on some days you might make money, on some days you might lose money. The real question is about sustainability. So if you know your strategy is sustainable, you tested it over like 100 trades, you have an edge, you have risk management. From there, it's all about execution.